Let us see the next question. WX Limited has a machinery which has been in operation for 3 years. So the company is already using it for 3 years. Its remaining estimated useful life is 8 years. Yet it can be used further for 8 years with no salvage value in the end. Its current market value is rupees 2 lakhs. The company is considering a proposal to purchase a new model of the machinery to replace the existing machinery. So there is a question about the replacement. The relevant information is as follows. For existing machinery and for new machinery, information is provided to us. Company follows SLM, straight line method of depreciation. Income tax rate is 30%. WX Ltd does not make any investment if it yields less than 12%. Means 12% is the cost of capital. The present value of annuity of rupee 1 at 12% discounting rate for 8 years is 4.968. The present value of rupee 1 at 12% rate of discount received at the end of the 8th year is 0.404. The question says that ignore capital gain tax. Advise the company whether the existing machinery should be replaced or not. That is the question. Dear students, we can see that the remaining life of the existing machinery is 8 years. And the life of new machinery is again 8 years. So since the balance life of existing machinery and life of new machinery are same, we can adopt the incremental approach for the purpose of decision making. So we will adopt incremental approach over here for decision making. So we understand like this. Please write an answer along with me. Incremental approach for replacement decision. In that, write down replace existing machinery, comma, over continuation with existing machinery. That is the way we will adopt the incremental approach for decision making. I request all of you to do step number 1 to step number 3 on your own for like the incremental approach. So it is continue, replace, continue, replace. That is the way simultaneously we will make the calculation. Let us have a discussion that's how to do answer. I am discussing the first 3 steps with you, dear students. Step number 1 is investment. In case of existing machinery, the amount of the investment is 0. In case of the new machinery, that is if at all you replace the existing machinery with new machinery, there is an investment which is supposed to be made of an amount of rupees 8 lakhs. We understand that the purchase price of the new machinery is 10 lakhs and existing machinery can be sold for rupees 2 lakhs today. We understand that we do not have to compute the capital gain or loss on sale of existing machinery. Why? Because the question is providing the information that you have to ignore capital gain tax. So in case of the new machinery, that is in case of the replacement, so there is an investment to be made of 8 lakhs. Step number 2 is depreciation. We understand that it is 3,30,000 divided by 11, that comes to 30,000 because the scrap value is 0. In case of the new, it is 10 lakhs minus 40,000, so it is 960 upon 8, that comes to 1,20,000. Terminal cash flow 0 for the existing and 40,000 in case of new. That is the way step number 1 to step number 3 will be applied. So please write down answer. Step number 1, investment. In that, existing and new. In case of existing machinery, investment is 0. In case of the new machinery, there is an investment to be found like this. Purchase new machinery for an amount of 10 lakhs less sale value of existing machinery, an amount of 2 lakhs. So investment is 8 lakhs. On sale of existing machinery, comma, capital gain or capital loss is not required to be found because we have to ignore capital gain tax. Step number 2, depreciation. In that, existing machinery and a new machinery. For existing machinery, it is cost divided by number of years. Cost is an amount of rupees 3,30,000 divided by 11. Why? Because there is no capital gain tax. Sorry, there is no scrap value of the machinery. It is 30,000 rupees per year. And dear students, we understand that already 3 years have been expired. Okay, 3 years have been expired. So this is the depreciation that we can claim from year 1 to year 8 now onwards. For new machinery, cost minus scrap value divided by number of years. So it is 10 lakhs minus 40,000 divided by 8. So it is 9,60,000 divided by 8, 1,20,000 rupees per year. Again, this is year 1 to year 8. That is the way we will have the depreciation for the coming 8 years. Step number 3, terminal cash flow. The first working note is not required to be prepared, capital gain or loss on sale of machinery. Why? Because we have to ignore capital gain tax. So directly terminal cash flow for existing machinery and for new machinery. Scrap value of the machinery is 0 and over there scrap value of the machinery is 40,000. That is the way we will have the terminal cash flow, say for both of them, and this is going to be received year 8. Step number 4, recurring cash flow. I request all of you to do recurring cash flow on your own and put your answer in the chat box. Let us start a recurring cash flow. In that, say we have been provided with the information about the existing machinery and new machinery. We start with the sales. Students are requested to write down answer along with me. Selling price is 15 and number of units are 30. So we understand that's over here 15 into 30,000. That comes to 4,50,000. With the new machinery, selling price is 15 but the number of units are 75,000. So 15 into 75,000, 11,25,000. Variable cost. It is consisting of the direct material 4 rupees per unit. And over here also it is 4 rupees per unit. So 4 into 30,000. And 4 into 75,000. This is 1,20,000. And over here it is 3 lakhs. This is direct material. Direct wages. It is 40 rupees per hour. And it is 70 rupees per hour. And operating hours are provided as 3,000. So 3,000 into 40. And over there it is 3,000 into 70. So it is again 1,20,000. And this is 2,10,000. Depreciation. It is 30,000 rupees per year, that is per year. And over there it is 1,20,000. Okay. Then indirect cash cost per annum 50 and 65. Indirect cash cost 50,000 and 65,000. All expenses will be deducted from revenue to find PBT. So what will happen? 4,50,000 minus 1,20,000 minus again 1,20,000 minus 30,000 minus 50,000. So it is 1,30,000. And with the new machinery, 11,25,000 minus 3 lakhs minus 2,10,000 minus 120 minus 65,000. So it is 4,30,000. Profit after taxes. See, the income tax rate is given to us in the question as 30%. So profit after taxes is 70%. So it is 91,000 and over there it is 3,01,000. Add back depreciation. Why? Because it is a non-cash item. 30 and 120. So cash flow. 121 and 421. So the new cash flow is 421. Existing is 121. So there is an increase in the cash flow by an amount of 3 lakhs. This is the way the incremental cash flow can be calculated with the purchase of the new machinery. After making recurring cash flow, step number 5 is NPV. Calculation of NPV. In that, year 1 to year 7 and 8th year. Cash flow 3 lakhs annually, and last year it will be 3 lakhs plus terminal cash flow. 40,000 minus 0, because what you receive is 40, otherwise what you would have received? Nothing. Discounting at the rate of 12%. We have been provided the factor as 4.968 for 8 years. From that I am eliminating the last year factor 0.404. So for the year 1 to year 7 factors are 4.564 and last year factor is 0.404. These cash flows will be discounted with the required rate of return for NPV calculation. So friends, last year cash flow will be 3,40,000. I'm sorry, I did not mention it correctly. And as far as the year 1 to year 7 factors are concerned, that is found as 4.968 minus 0.404. This is the way it will be calculated, and then NPV will be found. So here it is 3 lakhs into 4.564. Present value is 13,69,200. $340 into 0.404, 1,37,360. So the summation of both of them is 15,06,560. Less investment. Amount of the investment is 8 lakhs. How this 8 lakhs is calculated? It is new investment of 8 lakhs minus the existing investment 0. In a way that we are required to consider the incremental investment, and NPV is found 706,560. NPV is positive? Yes, it is positive. So we should replace existing machinery. So summary of the answer. Step number 1, investment. In case of the replacement, there is an investment of 8 lakhs, otherwise 0. Step number 2, depreciation 30 and 120. Importantly, depreciation of 30,000 can be calculated for, that is, can be claimed for the remaining 8 years. Terminal cash flow 8th year end. In case of the new machinery, it is an amount of 40,000, otherwise it would be 0. Recurring cash flow, new 421 and existing 121. So there is an increase by 3 lakhs. And lastly, NPV calculation. So one line answer is, as NPV is positive, comma, the company should replace existing machinery. Full stop. Please write an answer.